Thank you and good evening, everybody. As usual, I will focus in this particular order on the economy and the stock markets and on investments. Thank you for joining this month's update. So let me start off with the economy status update, where I'm going to first focus on the country's fiscal situation. I know the budget is been some time since it happened, but I think as you'll see in the coming slides, I think the budget was a very important thing in the context of FII flows, and why that was so, I think I'd like to take a few minutes. So first of all, if you see, I'm taking a slightly longer term view of what the budget represents and not just this year's budget. So you see, right from 2000, if you look at the trend of our thing, right, the fiscal consolidation has been a big story that we've been doing, and how the quality of the expenditure between revenue and capex has been altering. So you can clearly see that from 1.5% to 2% average capex expenditure, we have now upped it by almost double to 3.2 to 3.4%, right? So as a result, if you see, not only is the quality of the expenditure, which we will dwell on a little more, the fiscal consolidation trend. See, during COVID, every country was permitted a spike. We also took advantage to 9. But since then, we have consistently brought it down. It's still not completely down to the pre-COVID levels. But if you see in 2010, 11, 12, we're broadly running at the same levels, right? So clearly, there's a commitment to reduce the government's balance sheet and the borrowing, right? And though, as I said, the consolidated fiscal, which is not only the central government, which is in red, you take the state government deficit, right? They are quite high, and we are still above the pre-pandemic levels, right? So states obviously have stepped up their borrowing, so it's been constant at around 3%, right? Then the other thing is that in recent years, the effort to keep this, if you compare the April to December actual deficits, what the budget promises for this year and does next year is a different issue. But if you look at the actual April to December, we used to exceed it much earlier. If you can see the dotted line, that's a full year deficit. And we used to exceed it in many years by April to December itself. But you can see the discipline that we are now keeping that to the proportionate levels, right? So from that point of view, right, where is the government spending? So if you look at the past 5 years averages of each of these, which is the inner circle, and the outer circle tells you this year's estimated expenditure, that's 24-25. You can see that interest from 19 to 20 is stable. Where the increase is in the central sector schemes from 14 to 16%. Otherwise, broadly, the allocation has remained the same. So clearly, the government plans to spend more on its schemes while cutting subsidies. I think that's the important part to remember. From an 8% average subsidy level of the budget, they are bringing it down to 6%. So again, from a foreigner's perspective, right, the India's risk is manageable and coming down. And we spoke about the quality of expenditure already in the first slide. I'm reiterating that because I want to take that story forward now. And so if you see capex as a percentage of total spending, right, that is growth steadily year on year. So while the government is maintaining a fiscal deficit, which is they're borrowing more than their revenues, they are spending it in the right direction, which will promote future GDP growth, right? So there's a 17% growth in the center's capex and a 14% increase in total capex, including the PSU capex. And specifically, the incentives given to PLI are very critical because, as you know, India is fighting a battle with China to get more of the share of world exports. And the PLI scheme is specifically meant to give subsidies to companies which are willing to shift their production facilities to India, most probably which are already based in China. So this allocation to PLI also, the incentives are picking up, right? And hence, we are going to see investment project to rise a record high of 35% in this year. And where that is spending is happening is in roads and railways, because they are the ones where the greatest employment generation takes place. Second, multiple industries benefit from a building of a road and a railways. So the multiplier effect is not only in terms of the business growth for various sectors, but also in terms of the employment generation, right? So at the same time, if you see the government's income side, they are depending on tax revenues more increasing thanks to GST collections you will see in a later slide, and direct tax collections going up. So their debt, the government's borrowing and disinvestment. So you can see that every year the government has come under their disinvestment target, right? So I'll talk that in a later slide. But if you see now, the rising share of direct income tax in total tax collection is a positive, which means more and more people, corporates as well as individuals, are paying their taxes. More and more of they are disclosing. The formalization of the economy is actually also getting reflected here, right? So the actual tax revenues in the last 3 years have met or exceeded the budget estimates. Again, a very healthy sign for our country, right? Naturally, the indirect tax collection, GST collections in January and then February later, you will see the second highest on record. And their asset sale, the disinvestment is the lowest in recent history. Now, why do I say this is a good positive? Because this is a one-time effort. It's not sustainable. How much of the government's family silver can they keep on selling? So while they project it when they plan the budget, they actually don't go and do that much disinvestment, because end of the day, the government, unless they are going to give control to the private owners, right? Disinvestment is just a way of making money for the government. And to the extent that they use less capital and more income through tax to finance their budget, the better it is, right? So naturally, from that fiscal deficit reduction, it has to come from a subsidy reduction. And that's again a very good path the government is following, right? And hence, net result of all this is that the government expects to borrow far less in FY25. And if you see, though they're borrowing less, actually the government bond market has doubled in the last 7 years. So you know the rule of 72, so it's almost at about 10 to 10.5% per annum. The government bond market has grown, but both the gross market borrowing and the net market borrowing, the government is bringing it down. So overall, from a picture, right, the government's fiscal deficit is coming down, the government's borrowing program is coming down, the government's tax collections are going up, and the quality where they're spending is also more on investment as compared to revenues. So all in all, a very good picture of the way the government is managing the economy. Now let's look at the economic indicators, right? So if you see, first thing, headline and core inflation both have seen appreciable moderation, right? Next is, if you see exports, right through, they have helped us to maintain our current account deficit. Services exports has greatly grown in the last few years, right? Second is that we are talking about consumption. So that in the rural, the good news is that average nominal rural wages are inching up. This is the same period comparison of the last 4 years. So if more money is there in rural people's hand, they'll spend more, and which is good for the overall consumption growth of the economy. However, on the capex side, overall projects under implementation saw a little bit of moderation in the month of December, right? And even new investments saw that. So if you see both public and private, so clearly the government in the run-up to the election is probably not launching so much new, and private sector, because capacity utilization is still stuck at 76, is not really picking it up. So the capex story, while it's there in the medium term, in the recent months hasn't really taken off, right? But railway freight, which is a good indicator of economic activity, is holding up. Air cargo is seeing some strength, which means exports on the back of market share exports. Total air passenger traffic's momentum is also good, right? And if you see a number of short frequency indicators, right, I would encourage you to just look at the color coordination. So what indicates? Green indicates that better than last month. Red indicates worse than last month. The other colors are in between. So if you see the Jan and the Feb data, by and large, it's a green and a yellow, which means the economy is by and large stable to doing better across a range of short frequency indicators, right? Some of them from a longer term trend perspective, you can see that the V-shaped recovery and then the gradual increase month on month is clearly seen across power, GST collection, rail freight, two-wheeler sales, credit, PV sales, and e-way bills and vehicle registrations, right? Some of them will go in a bit detail. Power demand growth is holding up, which means industrial activity is doing well. Credit growth continues to hold up, which is very good at about 15 to 17%, right? And credit growth to industry, within the breakup of this, credit growth to industry has recovered, which is where the multiplier effect of bank lending will come in, right? We already spoke about the GST collection. So if you see even February month, and it has come to 1.68 lakh crore, slightly less than the January 1.74, but still a very, very healthy number, right? EBA bills, not any official softness, continues to trend higher. And more importantly, as a predictor of the GDP, both manufacturing and services PMIs are well above 50 and trending strong. there, right? So augurs well for the future months. And within the various sectors, two-wheeler and passenger sales growth are reflecting the underlying demand, probably correlated to the wages in rural sector going up, right? And if you then index the components of the GDP, exports have improved the most from pre-COVID levels, and private consumption has witnessed a rebound in the December quarter, right? So good news everywhere. So overall, if you see from a growth perspective, you take a trailing 4 quarter to dampen out the quarter-on-quarter effects that you get, which are up and down. We are looking at a trailing 4 quarter GVA of over 7.7 and 7.2 and a trailing GDP of 7.7. So augurs very well. So naturally, for 2025, India with a projected GDP growth of 7 will continue to remain the fastest growing economy in the world, right? So overall, to summarize, the economic news looks pretty robust and good, right? Now we move to the stock markets, and let's take a world to the world stock market and look at the eyes on USA. Why am I focusing on the USA? Most of the currency reserves of the world, 60% are in the US. So because the central governments of various countries, sovereign wealth funds, deploy this money in and out, it is the US market which drives all the stories. So from there, if you see, I'm going to compare Jan end, Feb end, and March end as a continuous to trend. And if you look at the 1 month trends, right, both the Dow Jones, Nasdaq, and the S&P in Jan were about 1% positive. Next, when you come to the next 1 month, you saw the Nasdaq and the S&P have suddenly sparked up. So clearly what is happening is that the new age economy stocks, right, are the ones which are doing better. And then when you come to March 11th, again the same, though the 1 month Dow Jones is flat, again Nasdaq and S&P 500 are delivered better returns. So clearly the US stock markets are in a good run. And what is the reason for this? You see, is that the dollar, if you look at the movement of the dollar, right, the 10-year, the 1 month, the dollar has actually strengthened marginally. So you're saying some amount of rate hike talk in the US, but if you then look at it from the fact that the 10-year has gone up slightly, right, that's the indicator of the future. Then for India, if you see from 7.14, the interest rate cycle has come down to 7.08 in February and 7.02 in the month of March as of 11th yesterday. At the same time, look at the US 10-year movement, 3.91 in Jan end, moved up to 4.25 in Feb end, but is back down to 4.1, right? So again, the US interest rate spiked a bit because the Fed was talking about some kind of a delayed rate cut and some little bit of hike there. That's what is reflecting. The third aspect here is to look at the dollar, INR dollar. So again, I take you to January 83, down to 82.91. Now down to 82.77. So the rupee is actually strengthening, right? And so if you see this slide and see 1 year, the rupee has depreciated only by 0.8%. So rupee has been very strong, whereas the 3-year average is 13.7. As you know, the differential in interest rate between the US and India reflects the depreciation. So you can see that between our 7% 10-year rate and the 4%, 3% per annum should be the depreciation. Over a 3-year period, that's roughly come up that way. But on a 1-year basis, the rupee has actually strengthened relative to that. So that's the story, which is again the good Indian economic story playing in. And there is also a story of a dollar's weakening story. And if you see why that is and why the stock markets are also getting money, it is the ample liquidity available in the US, right? And now when you then go forward, right, and look at the Indian stock market, right, it's important, of course, to remember who owns the stock market and who buys and sells. As you can see, 42% of the stock market is shut for outsiders because it's the private promoters. Of the rent, FIs have the largest share. They're about 33% of the free float. Mutual funds are a big, strong player with 15% of the free float. So from that point of view, then if you look at the FII, there's a short-term component and long-term component. Long-term component comes linked to share of India's global GDP because they are for 10, 15-year investment. Short-term comes from multiple factors, from currency, from oil prices, and the rest. So other aspect of this is that passive overseas funds dominate Indian flows. And that's because India's share in the indices has been steadily rising, right? It's now gone past this 15.5 to close to 16. And the flows into our country also mostly from the passive side. The reason I mention is that's why when that money comes in, all the sectors in the large cap tend to go up. regardless of their outlook, because it's the India story that is playing out through the passives, right? Active allocations, if you look, 28% of global fund managers are overweight on India, right? And if you see India's change post-COVID, we are the country whose share of global allocations has gone up the maximum at 7.4 at the cost of Russia and of China. So if you see here, it reflects very clearly. First of all, if you see the ETF flows, China's ETF flows, the white line, are coming down. India's ETF flows, the blue line, are going up. As a result, if you see that the Sensex and the Chinese Shenzhen index are going into different directions in terms of their performance, right? So naturally, the reason for this is also the way the short-term hedge funds are behaving, right? So when you look at an outlook for the short term from India, right, you got to look at the situation in advanced countries of inflation, interest rates being soft, currency, they are weakening, and ample liquidity is available. And if emerging markets are attractive, money flows into emerging market. Within that, India's attractiveness will attract money into India. So global inflation, as you can see, is overall trending down. In fact, India today is among the higher countries in terms of inflation. So global inflations are leading to the lower interest rates, which we spoke about. And you saw the trend in the US 10-year from 4.1, it spiked up and came. But perhaps the best indicator is the gold prices, because gold is an alternate to the dollar. And so if you see here, just between Feb to March, see how gold has 1 month return has gone to 7%. So gold is a powerful indicator of the future dollar movement, which I would say is also the future interest rate movement. So a weakening dollar means there's a strong chance of rate cuts happening, and that's where the global allocation into gold, that spike in 1 month of 7%, is telling you what the markets think about, regardless of what the Fed is saying yesterday, today, tomorrow. The medium-term trend is of a weakening dollar along with the drop in interest rates. So that then, compared to world liquidity, which is still hovering at about $25 trillion, augurs very well. The only thing for India is oil prices. Why? Because when oil rises sharply, all these negatives happen to India, and oil then falls, all these become positives, right? So if you look at a longer term trend, I've taken this chart through you multiple times. There is a strong correlation between short-term hedge fund flows and the expected trend of oil prices. So from that, when you move on and you realize why that is, because it is because even a small 10% drop in world oil demand means that oil becomes a surplus and oil prices tend to crash. What is the trend like now? Most recently, thanks to the Baltic, the tensions around the Red Sea and with the Houthis and the attack, oil prices tended to slightly go up. But if you take a future estimate for the rest of the year, you can see that clearly oil is expected to spike a bit, but then stabilize. So augurs well for a short-term hedge fund flows also into India. Supporting this is, of course, domestic MF flows, which have matched hand in hand since COVID, the FII flows into the country. So strong domestic buying means that today, domestic participation has made FII holdings of India dropping to a decadal low, and the balance of power between combined domestic flows and FIIs has shifted from a 45% for domestic share to now a 50% plus of domestic share compared to FIIs. So these are providing a great stability, and hence when you move to the valuation piece, let's look at what the earnings are telling us. This earnings for the quarter, if you see, by and large, if you see, the Nifty small cap is delivered about 42%, mid cap about 43%, the large caps about 19-20%. So clearly, in the short run, the mid and small caps have delivered better earnings growth than the large caps. And if you see the nominal corporate revenue growth, overall top line, this is the sales, is slightly moderating on a normalizing basis, but still growing. And hence, from a EPS growth perspective, if you look at it from a longer term trend, right? From 2003 to 8, we had that boom period. And then since the global financial crisis, overall Indian earnings hasn't grown that much, only a 4% CAGR. But now we are again on a pitch where from a FY20 COVID bottom to the year 26, we are expecting a 19% CAGR in the EPS growth of the Nifty, right? So that kind of a strong growth spread across the board in terms of the various sectoral growths. So all the green sectors, the one which have actually done very well. And hence, from that point of view and an update, if you look at it, there are clearly set of good sectors and some sectors which are yet to catch up. And hence, from a house view perspective in terms of the sector, based on this, I've given the 1 month return of that sector within the Nifty 500, the 1 year return, and where we are outlook. So you can see, by and large, at Sundaram, we are reasonably bullish in terms of the sectoral play and our overweight on financial services, auto, consumer discretionary, pharma and healthcare, construction, and manufacturing as a house, right? So, and the other thing with the earnings growth is that if you look at the MSCI index, the coverage stocks, more than half of them are beating the expectations of the analyst and are also outperforming the Sensex results, right? So overall, Nifty 50 earnings for this year is expected to hover around 20%, right? In that context of those earnings, large cap valuations relative to the world, we continue to be at a premium relative to the world, because if you see, emerging markets overall are not doing so well. The US stock market is doing well, so it is the highest valuation. But India continues to trade at a premium both to the world market and to the emerging markets. And why this premium is India deserving it? Because from a market volatility perspective, one of the things they hate about the stock markets is volatility, which is what the standard deviation and the risk tries to capture. So if you look here, what's happened is that India, if you take the middle black line, over a period for the current year itself, 2024, if you see the projections from 2.5 years back to now, fairly stable from a 917 to 943 perspective, right? That means that there's a stability to our country's growth expectations from an EPS growth. That's number one. Second aspect is the length of tenure of various types of investors, whether it's FIIs or domestic investors. FIIs because the component of sovereign wealth funds and pension funds has gone up, and domestic, we all know, because the SIP book has gone up. So the longevity means that the volatility in the stock market is much less. Hence, if you see from a VIX index, compared to the world and compared to India, we are more or less at the same level of volatility. We are not a more volatile country. So hence, India's beta is trending down. So we are moving away from being a very cyclical stock in an FISIs to a more stable a la FMCG kind of a lower beta stock. I think that's the reason why. And if you see, having invested with a high PE into India, the returns post-COVID, if you see, India and the US are the top markets from a return perspective to FIIs, as well as the fact that you take a longer term period, 10-year and 20-year returns in dollar terms. India has delivered 12.5% in 20-year returns and 7% in 10-year CAGR. So obviously, FIs who've taken this call on India, despite buying at higher valuations, have made among the best returns in the world from our stock market. So that's what reinforces their faith back into our country. If you compare to our own history also, yes, we are trading slightly above our long-term average on a 1-year forward PE basis, but we're still way away from those hyper valuations which prevailed in October 21 and in March 2019. From those periods, we're still way above. So yes, we are more expensive than our longer term trend, but if the markets rise further, there is room to absorb that from a large cap perspective, right? So coming forward now, go to the broader market. If you see the trend of the broader market, the overall market, while it looks at a green kind of a territory, what I'd like to point out to you is the strong move in the small and cap prices, right? From the beginning of March, when they were trading at a discount, at a lower 1-month return for mid cap and small cap last year, March was negative, to now in February, if you see 1-year returns are obviously very, very strong, right? So why is that happening? Because if you look at the fund flows, right, there's a significant shift that happened in January, February, March. FIs were selling. And then from April, May, June, they started buying, and there were 2 months when they sold. So what has happened is that this sudden inflow of FI capital meant that fund managers reallocated. So now when you look at the relative valuation charts, right, in the month of April, mid caps and small caps were trading at a discount to the large cap. Top left table. -8% was the discount that the mid cap had to the Nifty, and -3%, 2.9 was the discount small cap had. Today, in the brought it up to November in this table here, they both are trading at a 14% premium. And then when you come to December, right, you will see that the premium of mid cap stepped up to 16 and 10. Go back to forward to January, it's at 14 and 22. So small caps went up. And then in the month of February, you saw that they are 20 and 17. So clearly, while we saw that the earnings growth of mid and small companies was coming better, the growth in their share prices has been far greater than their earnings growth. That's why if you see from P ratio, their premium has shot up relative to the large caps. One of the drivers for this was the fact that in that period, in April, May, June onwards, you saw a lot of mutual fund managers with the sudden influx of FI flows reallocate in their large and mid cap funds away from large caps into mid and small cap. Similarly, in the flexi cap funds, number of flexi cap funds dropped their large cap down to 50%. And this is because if you see the concentration of the thing, mutual fund portfolio itself is concentrated at about 60% in just 33 stocks. So this shift away from large caps into mid and small cap naturally led to a strong rally. The beginning of that rally, and this again demonstrates that in a Nifty 500 index, it's a benchmark for most flexi cap funds. See, 26% of the market cap is governed by 400 companies, whereas 74% is only the 100 companies. So a shift in flows from this to that clearly leads to a huge divergence in returns, right? The second thing that happened was that there was a sharp mid-cap FII flows coming into our country sometime during the course of last year, which took the mid-cap valuations up. We suspect that it's mostly from dedicated flows which came from Japan, because a lot of Japanese money they raised with a mix of mid and small cap, mid and large cap in their portfolios, which has directly come and supported a rise in mid caps. The third thing is, of course, the flows from investors, where small caps, going by the past returns, naturally domestic investors preferentially favored small cap funds over a large cap, and that allocation led to this strong rise. You saw that right from April right up here. And also the widened retail participation, where you've seen small cap folios overtake mid cap and large cap to the extent that they've gone past 1.3 crore from just 50 lakhs a few months ago, meant that SEBI has flagged this risk. You're aware that recently they've talked to mutual fund managers to look at their concentration, the liquidity, whether they should moderate the flows. So all of this naturally has had an impact on small cap and valuations. And if you see now active fund management risk appetite, you can see that apart from multi-cap, where it's mandated to be 25%, and you look at the component of the focus, large cap, flexi cap, they've all brought down their small cap portions down now. So because of this reallocation that's been happening, the opposite of what happened last year from April, May, June, is that you are seeing that, yes. But I just want to give you a sense that when you look at the Nifty 50, the Nifty 500, large mid cap and small cap, every year, right, there is no consistent continuity of a green, which tells you that it's the best performing sector with a very strong positive, right? The dark green. So you can see that the leadership keeps turning. So please bear this in mind when we look at an allocation, 2000 more down to up, we're going, right? So last year, 56% return was a small cap tier, right? The previous year was 12.8% negative. Previous year was 58% positive. So leadership keeps changing and rotating. So keep that in mind when you look at asset allocation and what's happening recently. But that being said, there is some resilience in the mid and small cap valuations. Why is that? The strong growth in the SIP book. See, just February 2019, we were 8,000 crores. Today, we have hit 19,000 crores. This SIP book breakup, if you see, right, there are two things that I've circled here. First is 12% of this in mid cap, 17% is in December in small cap. So 30% of the SIP book is in this. But if you look at the incremental SIP book, you see that on the right hand, the second circle that I've circled, that's 30 plus 14. So 44% of the incremental SIP book has come into mid and small cap, right? And then if you see the lower circle where I've taken flexi cap, large and mid cap, multi cap, sectoral, which all contain, they all add up to about 11 plus 8, 19 plus 4, 23, 30% is in these multi caps where some amount goes to small and mid cap. So you take half of that, right? You're talking about almost half of the book being there, and the incremental book also is tilted. So if fund managers are getting money into mid and small cap through SIP every month, that builds a certain amount of resilience. So there's no need to worry or panic about a huge correction. Yes, there will be small corrections and volatility because fund managers are relocating, but the fact that there are flows to fund houses from investors on a regular monthly basis should give you some comfort. In fact, 1/3 of the SIP flow, the total flows in the industry are from SIPs, and 1/3 of the book of AUM of industry is also in SIPs. So I would say overall, not to get too concerned about this. There is good resilience there, but also at the same time, don't expect the same returns like a 60% that happened last year in small cap to again get repeated this year, right? The other aspect I wanted to say is we focus a lot on short-term flows based on currency, based on oil prices and all that, but probably India is also getting longer-term flows. So bear in mind that FII flows. So there, if you see, it's the share of global GDP. I want to take you through the fact that the outlook for the economy in the medium term is very robust. And over the next 15 years, we have a 3x multiplier of our GDP. We are on being the fastest growing country for a long period of time till 2027. And we are poised to overtake Japan and Germany, become the third largest economy by 2027. And hence, our share of global GDP is expected to shift upwards from 3.2 to 4, which means that you should get that much incremental allocation of the long-term capital, sovereign wealth funds and pension funds, and the fact that the downside risk to GDP, as I mentioned, volatility is a key factor for FIs when they look at a country, and we are among the lowest downside risk to GDP growth compared to the world. So this all adds to our low beta status, and hence you can expect long-term FII flows to continue to come and sustain the capital market, right? So in fact, this is what happened in the month of December when the election results got released. We saw 66,000 crores of flow coming. Yes, month of January saw some profit booking around the result season. You saw about 25,000 crores month to date January go out, but February again saw a gradually return. We got about 1,500 crores, not much, so pretty a flat month for February. But March, in the first 10 days, you're gaining again momentum. You have 22,000 crores of money coming in. So the point I'm trying to stress is that the FII flow, whether it's a short-term flow based on oil or a longer-term flow basis our growth pattern, is something that is continuing to sustain. There will always be blips when they take the pause and a breath, but the momentum underlying on flows should be positive. And in this table, I then draw your attention to the 1-month return, where you're seeing these FII flows have driven the Sensex and Nifty to deliver close to 3% 1-month return, but the small cap indices corrected 6%. This is naturally, you can attribute it to the actions of fund managers responding to the SEBI thing to create more liquidity, right? Kind of shifting their portfolios away from small caps where they're booking profits into the larger mid caps and mid caps. So that's clearly seen that the mid cap indices have corrected only by about 0.3 or 1.1, depending on which one. Small cap has corrected far more, but large caps have actually delivered. So keep this in mind in terms of an allocation when we will talk about it. And then when you summarize the flows around the emerging markets, you can look there that India quarter to date is still a negative, but from the financial year to date, we've had $23 billion of flows. And from a MSCI India in the middle, if you can locate it there, you can see in the 1-month return, because of the month of January saw profit booking and the effect of that, February was flat. If you remember, we are not among the best performing markets in the world, barring South Korea. But the moment you go to a 3-month, we are up there. And a 6-month, we are up there. So from a 1 year, year to date, those kind of perspective, we still continue to be the best performing market. But I would say that with March, the money coming back, we should again regain that status from a foreigner's perspective, right? And one important thing to remember here is the market oligopoly. That is, if you see the concentration of the market. So India is among the least concentrated market because 1/3, the top 10 stocks are only 1/3, but there are markets like South Korea where just 1/3 of the stocks account for 60% of the market cap. India is not very different from a UK where the 10 largest stocks are about 8%. Largest stock is about 8%, and about 10 largest stocks are about 34 to 35%. We are fairly, very diversified as a market. This is important from an FII perspective because they look very carefully at over-concentration in just a few stocks, like on the right-hand side, you see South Korea, Switzerland, and Taiwan, where the top 10 largest stocks are accounting for 60 to 70% of the portfolio, right? Right. So now when you come to recommended asset allocation, in the medium term, yes, we should always look at only at the medium term as an asset allocator. Customers' risk appetite is important. Obviously, you use this curve to decide where you want to put. Like the top end is the sectoral thematic funds of mutual funds, and the bottom end, of course, is liquid. Hybrids come somewhere in the middle, and mid and small caps there. So based on this, I would suggest that at this point in time, you are better off served by sticking to a flexi cap, large and mid cap, multi cap kind of an allocation rather than choose individual cap curves. The reason is that there is money in the fund manager's hands to rotate the cap curve as he sees fit. Now, you don't need to keep reallocating, look at taxation within 1 year, whether I do this, do that. Mutual fund managers do this in a tax-free, and flexi caps obviously carry the largest amount of large caps and multi-cap probably the least. So from a safety perspective, right, if you look at it, the risk reward comes goes down, goes higher. So choose a blended mix which should take advantage of the both the medium-term growth prospects of our country as well as this, right? So from that point of view, I'm just wanted to show you the cap curve to show you how flexi cap has the ability to add 24%, whereas a large and mid cap has the ability to add almost 50% in terms of non-large caps, and the multi caps also have that ability to have what 50% non-large caps. So gives you a beautiful blend of the overall capital market. The one thing is that if you are aggressive investor, which we're talking about, and you want to look at these ratios and maybe want to look at individual mid and small cap, please look at it as a business cycle timing, because timing your entry and exit for business is very important. Because even in the large cap, if you see year on year, the Nifty's earnings and the returns keep varying very, very rapidly. And that's because earnings growth on the left changes in a particular pattern, returns change in a particular pattern, right? So this correlation on a year on year will not happen because the market leads into the future, right? So now when you look at these 5-year buckets, right, I draw your attention to 5-year Nifty. See how widely those 5-year returns are varying. This is because of the presence of business cycles, right? So there, if you see, and you can broadly categorize the economy over the last 2 decades into a virtuous, virtuous cycle that's going on. And if you look at the kind of movement there, you will just look at it and say that in a virtuous cycle, you can see that the small caps do better than mid caps do better than large caps. When you come to a vicious cycle, the next one, you can see that a large cap gave protection, but mid and small caps notably lost heavily. The next virtuous cycle, the same previous virtuous cycle got repeated. You had 33% return from small caps, 29% from mid caps, and only 12 from large caps. The next bad cycle, again the story. You lost less money in large caps, more in mid caps, much more in small caps. And the current cycle which is going on, you have seen that. Again, large caps have delivered 30% from the bottom of the cycle from COVID to date, whereas mid caps have delivered 43 and small caps 51. So clearly, in a virtuous cycle, you have a greater allocation to mid and small caps, serves you better. That's why I looked at it and said you should have 30% in multi caps in your portfolio, right? And the reason I say that is these cycles last for experience of time, right? So the first good cycle lasted 4.8, the next one 4 years, this one has already crossed almost 4 years. So there are always gaps in these cycles, and what happens is that the bad cycles also have a time limit of about 5 years. One short bad cycle was only 2 years. So please bear in mind that from a cycle perspective, where do you think we are? We're just coming out of the bottom of COVID. In the early cycle, we are at the beginning of the up cycle, but as you know, it's only the government's capex which has driven this cycle up. The private sector capex is yet to happen. Now, that may happen with a bit of a pause, and there might be a period of consolidation in the market. But if you have a medium-term outlook, that will happen, and then you will get into the peak and then a late cycle. So once you cross this consolidation phase, you are ahead for a good long business cycle ahead of you, right? So with that, if you're a moderate risk person, the safer approach from an asset like investment, just take a longer term approach and serve you better. Why do I say that? The fluctuation gets more than. See, this is the way our nominal GDP has grown. And then if you look at it from a stock market, obviously the markets have gone up and down. This is the growth of the overall market capitalization. You can see how jagged it is. But when you put these into the same graph, you can see that over a long period of time, the trend line is that market follows nominal GDP growth of the economy. So as a moderate risk investor, you trust yourself in the time of the market, time in the market, helping you. And as you can see, 15 years CAGR, India market cap has gone 9.7 versus a normal GDP of 8.4. And it's not just in our country. In China and South Korea also, you've seen similar trending patterns. So as a moderate risk investor, you're better off just lengthening the extent of your staying, sticking to the diversified portfolios of flexi cap, large and mid cap, and multi cap. If you're a conservative investor, then obviously the hybrid category is best suited to you. There are various 3-4 types of funds. And broadly, if you see, These come in the middle of the risk reward ratio. And moderate risk investors, essentially, I would say you're looking for a longer term inflation and fixed income beating return, obviously taking lesser risk. From that point of view, the category as a whole for a long period of time, if you see for a 13 years, has by and large delivered. Obviously, equity savings takes far lesser risk and hence the return pattern is lesser, but all of them with equity taxation have given you fairly decent FD beating returns, right? And recently you've seen the sudden action in the multi-asset allocation. As you can see, the flows there have shot up. And what are these? These actually spread across three asset classes: commodities, fixed income, and equity. There are various ranges into which you can vary, and these funds have delivered phenomenal returns over the last few years. This is the top 3, 4, 5 funds in the industry, and the kind of category average return over 1 year, 3 year, 5 year, they have delivered very well. Why? What differentiates multi-asset allocation from the other hybrid category is that you're combining two risky asset classes together, whereas in the other hybrids, you're combining an arbitrage and fixed income with equity. So they are both dampeners to equity and hence give you that moderation of risk and reward. But this, you're actually mattering counter class assets, those which move oppositely but are equally risky. So when they hit a sweet spot and both do well, they deliver very good returns. But when they don't, they are not well correlated. So one of the key classes here is, of course, gold. And this then demonstrates to you the fact that if you put gold into the pool, along with a Nifty and a debt, you will see that half of the times over the last 13 years, gold has been the best performing asset class. So blending that with this, along with their low correlation aspect, means that overall, whenever Nifty has been negative in the history of the gold, you see 90% of the time gold has given positive returns. And when Nifty has been positive also, 36% of the time gold has beaten Nifty. So overall, if you see, about 40 to 50% of the times, gold has actually beaten equity in terms of returns. So combining them together makes eminent sense, and that's what those returns say. Plus, gold tends to give you a protection against currency depreciation, because the dollar price of gold translates to Indian price along with depreciation. You can see each of the 5-year buckets. That has been a key factor in deciding what will be a gold return from your portfolio. And the history of currency tells you that in short 3 to 5 year periods, currency can weaken as much as 3 to 5%. Over a longer term, at least a 2.75 to 3% depreciation has happened over a 25-year time frame. So that kind of a addition of value to your portfolio, because inherently the difference in interest rates between India and the US should mean that India should have a gentle depreciating thing over a medium term, and a gold addition to your portfolio helps this. So as a conservative investor, you have now an options of multi-asset allocation, equity savings, aggressive hybrids, as well as balance advantage, right? And the reason that gold has been doing well, will do well, as I explained before, is that gold has a negative correlation not only to equities as an asset class, but also to the dollar. So when the dollar is looking like weakening, sovereign wealth funds and others shift their allocations to gold. And so here, if you see, the last month, gold has actually gone up by 7%, right? And if you see the 1-year return of gold as of yesterday is almost 17%, right? So that's the reason that it's an important part of your portfolio to have products like this. Unfortunately, directly investing in gold today is not tax efficient. Hence, multi-asset allocation gives you a wonderful way of adding gold to your portfolio. The outlook for gold continues to be robust based on a report that I sourced, which says that somebody expects the gold to rise to 2,400 in the year. And the reason for that is essentially countries buying. So this gives you the overall countries allocation. Obviously, the USA, Germany, and Italy itself dominate the gold purchase, but India is not bad. India is 9th in the list of countries with the most gold reserves. So from that point of view, I would say look at multi-asset allocation funds also as a conservative investor in your portfolio. Thank you very much for listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.